There is a lot of talk lately about whether we are in an AI bubble, and there are experts on both sides of the argument. As retail investors, it's hard to know where to stand. Well, have no fear. I know the answer, and it might surprise you. The truth is that if you are a long-term investor like me, it doesn't matter. Bubble or no bubble, my plan is the same, to buy high-quality companies with improving fundamentals and stay invested for the long run. Always remember this quote from legendary investor Peter Lynch. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. In this episode, I am going to explain why the AI bubble talk is just noise, give an update on my portfolio, and go over some news from the weekend. Let's start with an update on my portfolio. This is the Hunter Fund, my $2.2 million portfolio that aims to outpace the S&P 500. In the past year, we are still well ahead of the market, returning 26.12% versus the market's 18.86%. However, year to date, the market is slightly beating me. It has been a choppy 2 months, and my tech-heavy portfolio has underperformed thus far. I am not selling out of any of my biggest positions. In fact, I am doing the opposite. I have added about $48,000 to the portfolio, and most of it went into these top 10 holdings. If the market continues to sell off these companies, I will continue to buy them. And this is why it doesn't matter if we are in an AI bubble. If you are invested in companies with healthy balance sheets that are growing revenues near or above 10% quarterly with strong earnings growth, you are insulated from most of the AI bubble noise. There are companies out there that have yet to generate any income that have parabolic stock prices. Heck, there are even companies that are pre-revenue with skyrocketing stock prices. If they are in the AI/data center space, then there is a 2000 dot-com bubble-esque feel to them. But speculation in the stock market is nothing new, so that is not unique to our current moment in time. What is unique is the massive amounts of cash generated by the hyperscalers. Amazon, Google, Microsoft, and Meta brought in a combined revenue of $1.6 trillion in 2025. A hyperscaler is a giant cloud computing provider that offers massive scale, high performance data storage, computing, and network services. They are defined by operating enormous data centers, often exceeding 5,000 plus servers, and they allow businesses to rapidly scale IT infrastructure on demand. The Big Four are Amazon, Microsoft, Google, and Meta. Together, they have forecasted $650 billion in capex for 2026. But the key is that they have the cash flows to do so. They're taking almost all of their operating free cash flow and dumping it straight into capex for AI infrastructure. If just the capex for these companies were a country, it would be one of the largest GDPs in the world. The amount of money being spent is truly unfathomable, and it is putting pressure on the stocks. The less money available for buybacks and dividends, the less chance of money coming back to investors. Additionally, Wall Street is completely spooked by the sheer volume of the unprecedented capex numbers. But as long as the CEOs of these companies believe that demand outstrips supply, they will continue to pour every available dollar into it. Companies that do not have the cash flow to pay for all of their capex and are relying heavily on debt like Oracle are getting clobbered. This stock is now a double whammy. It initially had a massive sell-off because of capex, and now it is getting punished even more due to the fears of AI disrupting software companies. To better understand the fears around massive capex, let's take a step back and look at the dot-com bubble. In the late 1990s, this revolutionary technology was exploding. It was called the Internet, and it was poised to change the world. Companies were adding .com to their name, and their stock would double overnight. Investors believed that the Internet would change everything, and they were right. But they forgot one thing: valuation matters. Many of these companies had no profits, no revenue, and sometimes no product. Yet the stocks were going up every day. The Nasdaq soared over 400% from 1995 to early 2000. Then reality hit. When investors realized many of these businesses weren't sustainable, the bubble burst. From 2000 to 2002, the Nasdaq fell almost 80%. Trillions of dollars in market value disappeared. The internet wasn't some sci-fi fairy tale, it was real, but the number of companies spinning their own fairy tales was ubiquitous, and bad businesses with extreme valuations went to zero. Even the best tech companies of that time crashed hard. Cisco was the Nvidia of 2000, and 3 months ago the company finally surpassed its March 2000 all-time high. It took 25 years for them to recover, but it was only because the company was egregiously overvalued back then. In March of 2000, Cisco was trading at a forward PE of 131 to 196 depending on your source. Today, Nvidia is trading at a forward PE of 21 to 25. Nvidia, the largest company in the world, just reported 73% revenue growth, 82% earnings growth, and they guided next quarter's revenue to be significantly higher than expected. All that, and the stock is down over 6% year to date. Investors are so worried about a bubble that they are discounting Nvidia so far out into the future to the point that growth does finally slow down. To me, this does not seem bubble-esque. AI is real, and it is going to change our world forever, but the build it and they will come fear is also real. In the 1800s, railroad companies massively overbuilt to the point of duplicate and senseless routes. In the late 1990s, telecom and cable companies laid so much fiber optic cable that only about 5% of it was actually used. Both of these technologies changed the world for the better, but the companies involved wasted enormous amounts of money in the process, and the supply far outpaced the demand. Over 90% of NVIDIA's revenue came from data centers, so I do understand the fear. This is an example of an industrial bubble. Here is a clip of Jeff Bezos explaining it and his views on bubbles in general, way better than I ever could.
In the year 2000, when the internet bubble burst, Amazon's stock in a very short period of time went from $113 a share to $6 a share. But to go from 113 to 6 in a short period of time was very concerning, and shareholders were upset, employees were nervous. We had all of our employee base, their parents were all calling our employees and saying, "Are you okay?" This was the environment of great nervousness. But I looked at the numbers in the business, and every month, as the stock price went from 113 to 6, a number of customers went up every month. Our gross profits went up every month. Our operating expense, we were still in a loss position, but our losses as a percentage of sales went down every month. Every single business metric, new customers, customer repeat purchases, everything that we were monitoring through that entire period kept getting better. And so that's one observation about bubbles in general. The fundamentals can be disconnected, the fundamentals of the business. And of course, as entrepreneurs, you're focused on the fundamentals of the business. The stock price is an output, an ultimate output that you actually have very little control over. Benjamin Graham, the great investor, is famous for saying, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And so as founders and entrepreneurs and business people, our job is to build a heavy company. We want to build a company that when it is weighed, it is a very heavy company. We do not want to focus on the stock price. And so that is, that will be misleading because it can be disconnected from the fundamentals. And when bubbles happen, so that's one thing that happens. The second thing that happens when people get very excited, as they are today about artificial intelligence, for example, is every experiment gets funded. Every company gets funded. The good ideas and the bad ideas. And investors have a hard time in the middle of this excitement distinguishing between the good ideas and the bad ideas. And so that's also probably happening today. But it doesn't mean that anything that's happening isn't real. Like, AI is real, and it is going to change every industry. In fact, it's a very unusual technology in that regard, in that it's a horizontal enabling layer. Today we talk about AI first companies like OpenAI and Anthropic and Mistral and so on and so on and so on. There are so many startup companies that are kind of AI companies of various kinds. And that's normal for this phase. But that is not the biggest impact that AI is going to have. The biggest impact that AI is going to have is it is going to affect every company in the world. It is going to make their quality go up and their productivity go up. I mean, by every company, I literally mean every company, every manufacturing company, every hotel, every, consumer products company, et cetera, et cetera, et cetera. And so that is hard to fathom, but it's real. There is no doubt, we don't know how long it will take exactly, we don't know how quickly that transition will occur, and it'll probably occur at different rates in different industries, but that is very real. Now, what the stock market does, which is when we think of bubbles, we think of valuations and market caps and things like this, and how many billions of dollars are being invested in these 6 people at a $20 billion valuation, even though they just started yesterday, right? That's very unusual behavior. Investors don't usually give a team of 6 people a couple of $1 billion with no product. It's rare, and that's happening today. But the great thing about industrial bubbles, this is a kind of industrial bubble, as opposed to financial bubbles, and I'll tell you what I mean by that. If you go back, like the 90s had a biotech bubble, and there were a bunch of pharma startup companies that were designing drugs and using new techniques, and the world got very excited. The investment world got very excited. As a group, they all lost money, but we did get a couple of life-saving drugs. A bubble like a banking bubble, the crisis in the banking system, that's just bad. That's like 2008. And so those bubbles society wants to avoid. The ones that are industrial are not nearly as bad. They could even be good, because when the dust settles and you see who are the winners, society benefits from those inventions. They still get those life-saving drugs. And that's what's going to happen here too. This is real. The benefits to society from AI are going to be gigantic.
If I were to align myself with one industry expert, it would be Bezos. There likely will be parts of the AI/data center build-out that are overdone. There will be winners and losers. There will be moments in time when great companies and their stock prices are dislocated from reality. There will be people coming out of the woodwork to prey on investors and make money while the iron is hot. The companies that I would stay away from are the ones on the periphery with no earnings or revenue. Buying these companies is just good old-fashioned speculation, and a lot of them have already run up to massive valuations. Some of them might be winners, but a lot of them will be losers, and I'm not risking my hard-earned money on them. Moving on to some news. Netflix has officially withdrawn their bid for Warner Brothers, and the stock jumped almost 14%. This is a clearing event for Netflix, and I think it will likely continue to move higher. Elsewhere in the stock market, the SaaSpocalypse lives on. These are the top 10 holdings in the IGV, which is a proxy for SaaS companies. Some of these companies are unjustly cheap, while others just look cheap. The problem for most of these companies is that there is never going to be an aha moment. Unlike Google, who had the DOJ case, and Netflix, who just withdrew their bid for the purchase of Warner Brothers, there will never be a clearing event for SaaS companies. The threat of AI taking market share from certain SaaS companies will always loom large. That is why Adobe is trading at a forward PE of 11. Even if the company continues reporting strong numbers, the consensus is that it's just a matter of time before AI eats their lunch, and that is a very tough stigma to break free from. And finally, just when we thought the market was choppy enough with all the AI disruption fears, Israel and America launched an attack on Iran and took out their leader. I'm not sure how the market will react. There is a good chance things stay choppy, though. The good news is that if you are a long-term investor like me, you don't need to worry about timing the market or talks of a bubble. You just need to own high-quality companies for the long run. That's it for this time. Thanks for watching, and I'll see you next week.